Hey everyone, I just finished doing a webinar on how to profit from the stock market crash. So what follows is a video recording of that webinar. Hope you enjoy it and trade well.
All right, good morning and welcome to today's webinar, Profiting from the Stock Market Crash. My name is Tyler Ballhorn. I'm the founder of Stockscores. I have been a trader for about 30 years, so I've got a little bit of time in front of the screen doing this sort of stuff. And today I'm going to talk about this very unique situation that we have before us, and really what I think is one of the greatest opportunities that we've seen in the 30 years that I've been trading, because crashes create opportunity. And that's one of the things, one of the themes that we'll go through. So again, congratulations for getting into the webinar this morning. It is oversubscribed. We have a limit of 500 people, and I know that we're far beyond that, unfortunately. And so I am recording this as a video, and if you are watching this as the recording, my apologies that we just didn't have more space, but unfortunately the crazy market condition means that webinars like this are even more popular than normal. All right, so what are we going to cover today? Here's the overview. My goal today is to show you ways to take advantage of the opportunity that comes from the crash. I want to give you some ways to make money off of this, and I'll take you through what I call my crash reversal pattern. It's been working great over the past couple of weeks. Just as a reference, on I think Thursday last week, I had one of my students email me to say he made $50,000 in a single day using the kind of things that I'll show you. So it's very important that I also emphasize how to manage risk, because although this market presents tremendous opportunity, it's also extremely risky. And if you are on the wrong side of some of these moves, you can really suffer a big loss as well. And we shouldn't avoid that thought. And so I will show you some ways to manage risk. I'll show you how to avoid being a normal human being and being emotional and chasing strength and having fear when prices are dropping. That is the biggest enemy in trading and in investing, is emotion. And I'm going to give you some ways to overcome that. I'll show you how you can learn my trading strategies. Again, I'm going to give you a little bit of a lesson on that today, but there's many different things that I do. Today we're going to focus on this crash reversal pattern that I've been using for the past few weeks, but I have other strategies, some for long-term investing, some for short-term trading like day trading, and we'll talk about those more so next week when I do some follow-up webinars to today. I'll give you some information on how you can participate in those webinars as well. Just before I continue on, is everyone hearing me okay? I've got a couple people making comments that they're hearing music and weird audio things, but I have no music playing, so all right, so looks good. All right, so, and then the last thing I'm going to do is take some of your stock questions. Now we've got 500 people in the webinar today, and so that means there's going to be a lot of questions. I'm not going to be able to get to them all. I'll try to touch on a few and give you a sense from different sectors where I see opportunities, and do my best to sort of help you with some tools so that you can go forward next week and in the weeks ahead to do this on your own. All right, so what have I been doing lately? Well, stocks like Boeing gave me a buy signal. Let me just get it going here. Gave me a buy signal right. Something screwy. Hold on just a moment here. All right, so Boeing bought it at 110. 3 days later, it hits 180. But then it also goes down from 180 to 120. You think about that. That's a 80% gain here. And then it dropped 35% roughly. And then since then, it's gone from 120 to 150. So that's another 25% gain. This is just in the last 2 weeks. This chart that you're looking at is a 30-day, 30-minute chart. And so you can see the incredible volatility that we have in the market, which is why I say this market presents some of the best opportunities that I've seen in a very long time, but it's also very risky, because the person that's buying up here and selling down here has got it all backwards. And we want to be the ones that are buying here and maybe selling up here and then buying it back here and selling up here. So those are some of the things I'm going to teach you how to do today, and why you would buy on the 23rd of March and not the 26th of March. The same thing can be applied on a longer term time frame. This is a chart of Suncor, Canadian listed stock, and you can see that it bottomed out at $14, and a couple of weeks later it was hitting $26. So that is, what, an 80% gain on a massive oil and gas company in Canada. These stocks don't normally move like this. And so again, I'm going to show you why we would, if you were a longer term investor, why you would sell it here and then buy it here and then sell it here. There's some very predictable patterns in there, and I will talk about that as well. All right, so continuing along. What do past crashes teach us? So this is something I've been talking about in recent weeks, and if you are a subscriber to my YouTube channel, you'll know that I've talked a lot about the opportunity that market crashes have created in the past. Without fail, every single market crash has been a great opportunity for profit, and I expect that this one will be the same. In order to take advantage of that opportunity, you have to overcome fear when most cannot. We are not trying to find the bottom. We are trying to get close to the bottom. In fact, trying to get the bottom is probably the most expensive way to buy a stock because you usually get it wrong and end up taking a loss. And so again, I'm going to show you a little pattern I use which helps us find something close to the bottom. Our aim is not to buy and become fully invested within a day. We're going to slowly accumulate positions as the market works through its bottoming process and as markets signal these opportunities. We have to prepare to be wrong because that is part of trading. And so, we may get a good buy signal and then 2 days later say, the market has proven us wrong, take the small loss, move on and try again 3 days later. And the volatility in the market has been such that has been what's going on. Risk management is therefore essential, and I will show you how I know where the exit door should be, how I know where I should take a loss, and how to size positions and that sort of thing. These are all some lessons that I'll teach you today. So this is an example of the S&P 500 and the fear and greed cycle that happens in all markets, and I'm going to use the S&P 500 to highlight this. This just simply goes back to 2017. It's a 3-year chart, and you can see that there was this cycle to the upside, and then where we had maximum greed, and then we had a fear-based sell-off. That was early in 2018. We had another little mini crash there in late 2018. And then, of course, we have this one, which is the most rapidly declining market that I think has ever happened. We have had bigger percentage declines for sure. The percentage decline out of the financial crisis was bigger. The percentage financial decline out of the tech bubble bursting was bigger, but it didn't happen as fast. Those bear markets lasted 1 or 2 years, whereas we have suffered, a 35% drop in a month, 6 weeks. And of course, since then, we've bounced back quite a bit. But there are these fear-greed cycles, and we know when greed is present because price runs away from the trend line. Now, you're probably wondering, how do I determine that? Well, what I've drawn on here in green is the trend line. That's an upward sloping line, and it's linear. When price goes away from it, that's that parabolic trend that I talked about on the radio today. And so anytime markets go parabolic, they are risky. And then the result is you get these fear-based sell-offs as the market goes back to being rational. And sometimes that fear-based sell-off just takes you back to the upward trend line and then it bounces and continues higher. Other times you will actually break the upward trend line and then you get a more substantial sell-off. And so you can see we go greed, fear, greed, and then this time we've had panic, colossal fear. However, the market has also given us numerous signals that it is bottoming. Now, those signals could be wrong, but so far those signals have been right, and there have been, in the last 2 weeks, great opportunities to profit from the market bouncing. The market went down about 35%, now it's down 20-25%, depending on what index you look at. So that means that many of these things have bounced back substantially. And whether you're looking at Canadian banks or energy stocks or US tech companies or gold stocks. There have been lots of great trading in both directions in the last little while. Now, if we look at sort of a longer term context of crashes, you can see that we had the tech bubble burst right there. We had the financial crisis right here. We had a little mini crash there. And then we had a sideways market that lasted 2 years, 2015 into 2016. We had that little mini crash at the end of 2018, and then this crash right here, which is the one we're on. This is actually, I did this chart at the end of March because this is a monthly chart. But what you can also see is that the monthly upward trend line has actually not been broken. And that is a good sign. It says that the world has not ended as many people predicted it would. Now, that doesn't mean that a month from now we may not break the upward trend line. We certainly could. We're always going to be defensive. We're always going to be cautious. But so far, all signs indicate that the worst is behind us. And although many people will argue, yeah, but what's going to happen when earnings start coming out and they're dramatically worse than normal? And I expect that when companies' earnings do start rolling out for this quarter, they are going to be significantly down, for most companies anyway, significantly down from normal. But remember, the market's already dropped a third of its value. And therefore, it has priced in a lot of that expectation. This is a very important lesson to take away from today. And that is the market does not react, the market predicts. So the prices that we are at today are a prediction of what earnings will be for the future. They are not a reaction to past earnings because past earnings so far have not suffered yet because the earnings announcements that we're hearing from companies now are based on the previous quarter. And that previous quarter was before COVID-19 took control. So it's going to be the next quarter when we see the negative earnings, and the market's priced that in. Now, if the market hasn't priced it in all the way, if earnings are even worse than the market predicted, well, that's a different story. But the market has essentially got a 1/3 haircut, and therefore the market's predicting that earnings are going to be, significantly less. Not 1/3 less. They could be significantly more than 1/3 because it's just one bad quarter. But I just want to caution people because on my YouTube channel, I get a lot of comments that get posted there. And I see over and over again, yeah, but earnings are going to be terrible. You're right. They are going to be terrible. But the market has priced that in. And the market is also starting to bounce because perhaps fear pushed prices too low. And that is where the opportunity comes from. We can take advantage of fear-based pricing. Now, how do I do that? I use something that I call the crash reversal pattern. I've been using this for years as a way to find stocks that are bottoming, but right now it's really an amazing way to find opportunity because we can look for these stocks that get sold off on fear-based selling and then they start to bounce back. And so here's what I suggest everyone does in the weeks and months ahead. First, prepare a list of stocks that you want to focus on. And I would encourage you to focus in on stocks that are, larger companies that have decent balance sheets that aren't going to go bankrupt. Some, like within the energy sector, for example, there will be oil and gas stocks that are really highly levered, and they may not make it through this slowdown which is really a double-edged sword because in particular with Canadian stocks, they're suffering from very low oil prices. They're suffering from a lack of transportation for their commodity to get it out of the country. And then, of course, the reduction in demand for oil is one of the reasons why prices are so low. So some of those stocks those companies could fail. But then there's the larger companies that have cash, that have decent balance sheets, that can ride this out. They will come out of this stronger because they're going to be the ones who can snap up assets at low prices and really 1-2 years from now be in much better shape. And you can say the same about a clothing retailer. You're going to get clothing retailers that go out of business, but then there's others that will survive and they will be stronger because there will be less competition. And so these crashes that we go through are kind of Darwinian. They get rid of the weaker hands in the economy, and then the ones that survive are better. And we saw that with the financial crisis. Some weak banks went out of business, but the ones that came out of it ended up doing really well, and their businesses grew. So what I want you to do is prepare a list of stocks that you want to focus on. And I would encourage you, if you're, for example, in the US, you'd want to focus on stocks listed on the S&P 500, and in Canada, stocks in the TSX 60. It doesn't have to be those, but just more established, larger companies that can ride out the inevitable storm that we are going through. The next thing is we're going to watch the stocks that you are interested in on their charts. And I'm going to use Stockscores charts because that's the website that I own. You can use charts from anywhere. And we're going to look at two charts. We're going to look at the intraday chart, either on a 13 or 30-minute interval. And we use that chart if we want to be a swing trader. Now, swing traders are traders that hold stocks for less than 2 weeks typically. 2 days to 2 weeks is a typical hold period. And normally that's not that lucrative for these larger companies, but right now you've got stocks like Boeing moving, up 80%, down 50%, up 30% in days, right? So it works well right now. Now for the longer term trader, we're going to apply the same pattern to the daily chart. And so the question you have to ask is, how much time do you want to put into this? If you're willing to look at the market through the day, and maybe you're stuck at home, you can't go to your normal job, and so you've got some time, then we're going to focus on that swing trading method. And if you don't have the time or the desire to look at the market through the day, you just want to maybe look at it in the evenings, then we're going to use the daily chart. Now, the other thing that you need is obviously a brokerage account. You need to be able to buy and sell the securities you want to buy. And so I know a lot of people are opening brokerage accounts because they see the opportunity. The downside of that is, from what I'm hearing, is that the time lag to get an account opened right now with a broker is longer than normal. And that's just because they're so busy. They're overwhelmed with people trying to open brokerage accounts to, fund those accounts and take advantage of some of the opportunities. Another thing, of course, you're going to need is capital. You can't make money without capital. But one of the beauties of this crash is that it takes far less capital to make a profit because the market is so volatile. And so normally if I wanted to, buy Suncor and take $100 of risk, that might be a $10,000 or $15,000 position. Now, because that stock is so volatile, the position size might only be $3,000 or $4,000. Now, what I just said about position sizing will make a little more sense when I show you some stuff in a minute. So don't worry about it if you don't understand exactly what I mean. But of course you need capital. And then the final thing is you need some knowledge and some discipline. I'm going to give you some of the knowledge today, particularly on this pattern. For those who want to learn more and really dig into the different strategies that I have and that are really working great in this crazy market, I'll sort of give you a sense of how you can learn more from me. And then the other thing that you need to bring is the discipline and emotional control. And if you cannot maintain discipline and do proper risk management, I really encourage you to stay out of the market because it is a volatile time. And if you don't have discipline, you can hurt yourself as well. So with risk comes reward. And there is tremendous potential for reward in this market, but also risk if you get it wrong. All right, so what is the crash reversal pattern? Well, it's working great. It's really a proven way. There have been so many stocks that have done this and significant gains just in the last 2 or 3 weeks. There are basically 3 requirements, and I'll show this graphically in a moment. Let's just list them off. We want a sharp and emotional sell-off. So there's lots of stocks that have done this in recent weeks, but not all have. A lot of the gold names really haven't suffered sharp emotional sell-offs. And then there's some of those staple companies like Kraft Heinz, which is a food company, and they sell stuff that preserves well. So, they're probably selling more Kraft dinner than ever. And if you go into your supermarket, you probably see that there's not a lot of it on the shelf because people are buying it up. So some of these companies actually are doing better in this environment. But most have had these sharp and emotional sell-offs. Then what we want is the formation of a rising bottom, which I'll show you on a chart. And then we need a break of the downward trend line. And if we have those 3 things, then we have a trading opportunity, but we must also size our positions in those stocks properly because our number 1 goal is capital preservation. We have to do proper risk management. And I will show you how to do that in just a moment. So let's take a look at Boeing. And this is an example that just fits all of those criteria very well. The first thing is, do we have a sharp and emotional sell-off? Well, this is just a 30-day, 30-minute chart. But back in early March, the stock was at $290 a share. If you go back a little farther into February, it was actually around $350 a share. And it had a sharp and emotional sell-off down to $90 a share. So we can see that that is there, that criteria. So next thing is we want a downward trend line to be broken. So how do you make a downward trend line? Very simple. Just find all the peaks on the chart and draw a line that best fits them. It doesn't have to be exact. This is an art, not a science. Just draw a line that best fits those peaks as they slope down from left to right. So I've done that very quickly. Incidentally, I'm using a little application that is free to download. It's called Zoom It. So when I draw lines on the chart like this, that's just a little thing that you can download. It's a Microsoft app. Just Google Zoom It, ZOOMIT, and you can draw on your screen as well when you're looking at charts. All right, so I have my downward trend line. Now then I need a rising bottom to build. So just like we talked about the peaks on the chart, which is where we drew our line across, we can also see the valleys, right? And you can see that these valleys here are falling from left to right. So we do not have rising bottoms, we have falling bottoms. But then we get a bottom here that is a little higher than the previous one. So that is a rising bottom. That's all, simple. If you can get a new valley that is higher than the previous one, you've got rising bottoms. And then finally, we wanted a break of the downward trend line from a rising bottom, which happened there on March 23rd. I bought the stock at $110 and change. I don't remember the exact price, but that was it. So then what happened next? Well, the psychology changed. Where there was panic here, eventually you get savvy, smart traders coming in and saying, hey, this has just gone down too much. Let's buy it. And the psychology shifts, and we shift from rising or falling tops to rising bottoms. And the stock went from $110 a share to $180 a share in 1, 2, 3, 4 days. All right. Now then, if we now draw a line across these bottoms, we have an upward trend line, and the upward trend line was broken on the 5th day, which told us as a trade, as a very short-term trade, it was time to sell. I think that was on the 29th of March. It was a Monday. And so when that upward trend line was broken at about $170, $165 a share, we had the signal to sell. So buy at 110, sell at 165 in 5 days, roughly a 50% gain in that very short time frame. Now, the next thing I want you to do is see if there was another time in April that this happened. So I'm going to remove all the lines, look at that chart, and try to visualize where those three things came together, where we had a sell-off, a downward trend line was broken from a rising bottom. I'll draw it for you in just a moment, but just try to visualize it yourself. It happened in April. All right, time's up. So first I'm going to draw my line across the tops. There's my downward trend line. And I have a bottom here, and then I have a rising bottom there, and I broke from the rising bottom, breaking the downward trend line. You could argue it happened here as well. And the next move went from, let's round it off to 130, and 2 days later it's at 160. So that's about 22, 25% gain. And then this upward trend line was broken, time to get out again. And on Friday, it did it again. Little downward trend line, rising bottom, break of the rising bottom from a downward trend line. Now the moves are getting less and less significant. So this move was big, but notice that these moves are getting quieter. So that is a process of compressing volatility. So if you are a longer term trader, let's say you don't want to look at the market through the day, Instead, you want to maybe check it in the evenings. What you want to watch for on Boeing next is for this longer term pattern, which is called a pennant, to be broken. So a pennant is something I teach in my course material. And if we can break out of this pennant next week, then it would be a longer term buy as well. If instead it pulls back and maybe comes down to the 135 range, then I'm going to watch for the next break of a downward trend line from a rising bottom as a cue to take advantage of it. All right, so we got that nice pennant pattern. Let's take a look at another example. This is Suncor, and this time we're going to apply our rules on the daily chart. So this is the approach that you would use if you are that longer term investor that doesn't want to look at the stock all day long. You just want to maybe check in the evenings. All right, so parabolic downward trend, emotional sell-off. Broke from a rising bottom late in March. And then it did it again here when we had this rising bottom and we broke to the upside. Let's use this one as our example. Entry was at about $19 a share. Currently we're at $22, $23. I think it closed on Friday at 20, or Thursday, because markets were closed Friday. Closed on Thursday at $22.75. That's great. Now, the next thing I want to talk about is risk management. So if we're going to buy Boeing or Suncor, we always have to plan to lose. So let's use this as our buy point at $19 a share. Now, the way that I manage risk is I look for the last inflection point to define my floor price. And so in this case, what is an inflection point? It's where the stock stopped going down and started going up. That's our little valley right there. And that was at $16 a share. So we're buying at $19. So we're going to buy at 19. And this is an example from the past. I'm going to show you how to find examples going forward as well. So we're buying at $19 a share. And our stop loss point is at 16. Now I'm not going to sell it just because it hits 16. I want it to actually close below 16. But for simplicity, we'll just use that. $3 a share in risk. So if I buy 100 shares and my risk per share is $3, then my risk is $300. Now that's not an absolute risk because it's possible that you don't sell it at $16. You may not be able to get out of it until 15, 14. So realize that while we can control risk a little bit, there's always variables that can cause us to potentially take a bigger loss than we planned for. But the point is, you can establish your risk fairly well and take a position size that is appropriate for the type of trader you are and your personal risk tolerance. If you have a $100,000 retirement account, $300 of risk is probably very reasonable. If you have a $5,000 trading account, $300 may be pushing it. You may only want to take $100 of risk. If you only want to take $100 of risk, then instead of buying 100 shares, you're going to buy, 35 times $3. That's $105 of risk. All right. So the position size is what determines the risk of the trade. But it's not just the position size, it's also where is support. Now, a common mistake that people make is they say, okay, I'm going to buy Suncor at $19. If it goes down 10%, I'm going to sell it. Well, 10% puts us in right about here. That is still way above that floor. So we always want to use the market's opinion. We always want to put our floors where the market stopped going down and started going up. There's theoretical reasons for that, and those are the kind of things that I teach in my different courses. We don't have enough time today, so I'm just going to sort of give you the quick and dirty version. But that is something to think about. Okay, if we go back to Boeing, we could do that as well here. This for a shorter term trade. If we're buying at 110, where was our last floor price? It was way down there at 95 or so. So 110 to 95, that was $15 a share in risk. So if we buy 10 shares, we would have $150 of risk on that one. Now those 10 shares went up to here. If we sold it up here at 170, then we made $60 a share in profit times 10 shares. We made $600 for $150 of risk. We call that our risk reward multiple we earned 4 times our risk. That's pretty good. Anytime we can make more than 2, that's good. So risk management, capital preservation is our number one goal. We should always plan to lose, but where you plan to lose is critical. We want to make sure that we're doing that at a recent floor price so that we are using the market's opinion to determine that risk management point, that stop loss point. You shouldn't take more risk than you are comfortable with. If you don't sleep well at night with $1,000 of risk on an individual trade, then don't take that many shares. Just scale back the number of shares that you buy so that your risk management is appropriate. You must have the discipline to take a loss if you are wrong so that you are in a good position later to take advantage of the next opportunity. Cash is king. If you have cash when the market is giving you buy signals and really good quality opportunities, you're much better off than the person who rode the market down and is 100% invested and has no capital to take advantage of the opportunities that are out there. So be willing to take losses is my point. So how do you overcome emotion? Because that is the great challenge. Well, there's a few things. First of all, have a plan. So I can teach you my method. You can have a plan. I've taught you some things today. Write that down. And the reason you have to write it down is because there are 2 parts in your brain that will make you make decisions in the market. There is the part that is the rational thinking part that happens in your frontal cortex. And that's the part we want to use. That's where we're analyzing risk. We're doing it rationally. We're doing good analysis. And if we can use that part of our brain, we're going to do fairly okay. However, the other part of our brain is this little almond-sized piece called the amygdala. And the amygdala is what saves us from getting eaten by a bear. We're walking through the forest, bear jumps out, we yell, we run the other direction, maybe we climb a tree, whatever. That is what nature has instilled in us to protect us from certain death in those kind of situations. However, in the stock market, the amygdala gets fired up as well because we are afraid of losing money. And when the amygdala fires up, when we go into fight or flight response, we make stupid mistakes. We make stupid decisions. Because it's not about thinking rationally, it is about just protecting ourselves. And so the downside of that is if you don't have a written plan, you will make impulsive emotional decisions. If you have a written plan, at least you have something to go back to, which you wrote when you were rational, when you wrote when you weren't in fight or flight mode, that will help you to make the right decision. So I want everyone, doesn't have to be more than a page, but write down a plan for how you're going to take advantage of the opportunities that are coming in this market. Number 2 point is to be comfortable with the risk you take. You will get more emotional if you take on too much risk. And so it's really critical that you don't exceed your risk tolerance, because risk tolerance is the point where you start to get emotional. So ask yourself, how much am I willing to lose trying to make money on a stock? Is it $100? Is it $1,000? Is it $10,000? Everyone's going to have a different number. That number is going to depend upon how much capital you have, your age and how close you are to retirement, and just your social makeup, your psychological makeup. You know, I have students that are comfortable, risking 10 grand and others that are comfortable risking $50. And there's no right or wrong. It's a function of what is good for you. You have to avoid that fight or flight response. And so when you feel yourself getting emotional, when you feel yourself getting impulsive, slow down, go look at your written plan, stop and think. We ultimately want to trust the message of the market. I gave up trying to be smart many, many years ago. I used to, I was a business school student. I thought I was smart. I would do all the analysis. I would make smart decisions, I thought. But it doesn't matter. You can be right, but if the market doesn't agree with you, you lose. And so I do not anymore try to be smart. I just do what the market tells me to do. And all I have to do to understand that is look at the charts, and the things that I've shown you today is about as sophisticated as it needs to be. If you can draw lines on a chart with a ruler and a pencil, you're able to make good decisions, especially in this market because there's so much volatility and swings. Now, again, today I don't have time to go into every little detail. I want to give you a high-level thing. If you want to learn more about it, you can take one of my courses. I'll talk about that in a moment. But I think I've given you enough today to at least take advantage of some of these things. If you choose not to take my course, it doesn't matter to me. Now, one other thing that I can help you with is that I put up a video on YouTube, at least one a week. And so I encourage you to go to YouTube. I'll just show you how to do this here. Go into YouTube, do a search for Stockscores in the search bar at the top. There you will see the Stockscores YouTube channel. There's all these videos here that you can get caught up on. It's all free. And just click on the subscribe button and then click on the little bell notification button as well. And that way you will get email updates when I upload a new video. Every weekend I do one video, but I do a few more sometimes through the week as well. So it's a good idea to make sure you're subscribed and to click on that notifications bell so that you will get those updates. Now, I'll just quickly go through for those who want to learn more about my approach. I'm going to do some webinars next week as well, and I'll go into more detail about my courses. I don't want to spend a lot of time on this today, and because we got lots of things still to do with looking at individual stocks. But if you want to learn my approach, I teach my strategies and processes to a small number of people each year. I run a course twice a year. This allows my students to use my tools. I have market scanning tools, and I have a webinar where you can watch every single day my trading screen and all of the stocks that are being signaled by my algorithms. So it's a great way to, have my support and my knowledge from 30 years of trading. And because I don't teach a lot of people, I can really give personalized service. Nobody works for me in that regard. All of the teaching is done by me directly, but I only teach about 100 people a year. So there are some webinars next week. These are all free. Tuesday, April 14th at 6 Pacific, we're going to do one on how to invest in the stock market profitably. I'll talk about some of the things I did today as well, but we'll go into a little bit more detail. On Thursday, we'll do one focused on day trading for those who want to be more active. And then next Saturday at 9 o'clock Pacific time, AM, I'll do one on the different course options that we have. These webinars are all free. They last about an hour. If you want to register for them, go to stockscores.com, go to Trader Training, upcoming events, and there you will see a list of all the webinars that are upcoming in the next little while, and you just click on the button there to register, and you can sign up, and then you'll get an invitation to the webinar. Now, I know today's webinar was completely oversubscribed, and I apologize if you're watching this as a video and you weren't able to watch it live. Unfortunately, with the market conditions as they are, we just had, I think, probably double the capacity of the room wanted to log in, and that's why I recorded it as a video so that everyone can watch it later. All right, just a quick overview of the courses. I have an investor course that is for people who want to be longer term traders. It gives you access to my strategies, to my theory lessons, to something called the market scan tool, which is how I filter the market for opportunity. So I go in here to the market scan, and I can run a strategy scan. So I could do this abnormal breaks Canada scan and run it, and it would find all of the stocks that meet the criteria of that one. And then I look at the charts to see if they have the right kind of chart pattern. It's an awesome tool for finding opportunities without taking a lot of time. You get email support from me if you're my student. You get access to that tool that I just showed you for 6 months, and then you can continue to access that tool for $300 per year if you have taken the course. The Active Trader course includes all of that, but it also gives you access to my active trading strategies, which are day trading and swing trading strategies. You also get access to a service called Active Live, which is a subscription service, but it's only open to my active trader students. And with Active Live, you can watch my trading screen in real time as it spits out all of the buy and short sell signals through the day. It's an awesome tool. We're having great fun, especially in this market. And again, I'll talk about these things more next week, but basically here's a summary of what Active Live is. Real-time, live, algorithmic, instant trade signals. I do the work so you can focus on making trades. I'm going to be complementing my normal online learning with some live webinar learning starting later in April. So on Tuesday and Thursday, April 28th and 30th, I'm going to do like an overview class where we're going to spend a couple of hours each night going through the theory. And then we're going to practice the theory for investors the following week, Tuesday, Wednesday, Thursday, May 6th, 7th, and 8th. We're going to do market scans in search of opportunities using the strategies that I teach you. And then you also get, if you are an active trader student, access to my active live service where you can watch my screens, you listen to me talk my way through the day. Again, awesome service for those who want to day trade. If you don't want to day trade, then you just do the investor course and we'll focus on this stuff instead. We have a special offer. Anyone who registers for one of these courses before Thursday, April 23rd at 11 will get those extra classes for free. And again, I don't want to dwell on this too much. We'll talk about this more next week. If you want to read this in more detail, just pause the video. Course pricing, this is all Canadian dollars. I know we have people in here from all over the world. Canadian dollars these days is less than typical because the Canadian dollar has fallen against the US. Investor course, $2,495. Active trader, $34.95. I know that I have a lot of students that have taken the investor course in the past that want to upgrade to the active trader course. You can do that from the Education Center on Stockscores. The upgrade fee is $1,250. All right, I'm going to launch a quick poll because I want to just, if you want a little follow-up email on the course offerings, then just answer this appropriately. I'll leave this up for just a moment, and then we'll get back to the next thing we're going to do is look at your stock questions, and I'll start to answer some of your questions. Now, again, because we have 500 people in here, it's going to be a little hard for me to answer every question. I'll do my best, and then if I miss some, I'm going to give you my email address so I can follow up that way as well. So I'll just leave this up for another 10 seconds. And I don't like to bug people, so if you don't want an email from me with information on the course, then just say no. I'm not hurting my feelings. I don't care. Leave it up for 5, 4. And by the way, if you're watching this as a video and you want an update, again, I'll put my email address up in just a moment and you can fire me an email. Or if you take in one of the webinars next week, we'll launch this poll again next week so you can get on my email list that way. All right, I think that's enough time, so we'll shut this down and get back to what we were going to do. As soon as my screen changes, there we go. All right, so let us take some stock questions and general questions too. But what I'm going to do is jump over to the Stockscores website. And now if you ask me about a Canadian stock, please put a T in front of the symbol because, actually I'll leave this up for just a moment. If you want to learn more about the courses, just go to this webinar web address, stockscores.com/learn. The deadline to get that bonus training is April 23rd, so you'll have some time to think about it and check up on me, make sure I'm not a fly-by-night operation. I've been teaching people how to trade the market for 20 years. I've been trading the market for 30 years. All right, so let's jump over to the Stockscores website and try to look at some stocks, and I'll give you my read of them. So first one we're going to do is OVV on the Toronto Stock Exchange. So fairly new listing, which means we don't have Stockscores indicators calculating right now. That actually doesn't matter for the crash reversal strategy. We don't care a whole lot about what happened with the Stockscores indicators. But what I need to do is just take a look at this chart and read it for you. So this is currently what I'm displaying here is a 30-day, 60-minute chart. So we had a steep downward trend, and we broke from a rising bottom there on, I guess that's April 2nd. So there you can see a low and then a rising bottom, and we're now in this little upward trend. So if you own this, I think it's a hold. I'm not crazy about buying it here. It's okay, but I think if you own this already, I think it's more likely to go higher than lower. I would be concerned if you start to break down through this $5.30 level. Next up, we will do Vermilion on the Toronto Stock Exchange, VET. So this looks like most energy stocks. So what I say now applies to most of the big energy stocks. So we had this steep downward trend. We broke the downward trend here. Synovus did this, Suncor did this. That was about 2 weeks ago. Since that time, the stock is already up 50%. Doesn't look like much, does it? But it's gone from $4 to $6 in the last 2 weeks. I think we're going to see most energy names pull back a little bit still. I'm hopeful that they do because they've kind of run up a little bit too fast, too far. So my hope is that next week we get a little bit of a pullback. If it doesn't, I would wait for a pullback. So I like energy names. I mean, they still have so much to make back. You know, that's kind of the old trading range. I don't think they're going to get back there in the months ahead. It'll take longer. But I do think that they can get, like, for example, on Vermilion, I think it can get to $12. I just think it may go down to $5 first, maybe even down to $4 first. And so on a pullback and a break of a pullback, I would consider it. Now, what to watch for? So I'm going to draw it out for you here because I won't be sitting with you every day. So I'm going to have to try to show you what to look for. So first of all, here is our upward trend line. Now this chart right now is a 15-day, 60-minute chart. I did that, just so you know how I did this. With Stockscores, just pull up the symbol. So I punch in T for Toronto, dot, and then the symbol, VET. Whoops. Okay, punch that in. Now I got the chart. Now I'm going to click on 15-day right here, and I'm going to make it a 60-minute chart, or a 30-minute, doesn't matter. Actually, I'll do 30-minute, I like that better. Then I've got my upward trend line. If that gets broken, we're going to pull back for a little bit, and it's going to start to do this. I would expect that maybe at $5 it'll bounce, maybe it'll go all the way down to $4, it doesn't matter. If it's going down like this, then what you want to watch for is our crash reversal pattern, which will be a break of that downward trend line from a rising bottom. So that'll be your next opportunity to enter Vermilion, Suncor, Baytex, Cenovus. All of these Canadian energy stocks are showing this pattern right now. So I feel like to buy them now is a little bit of a chase. They did pull back to the trend line and bounce, so we may see them continue the upward trend. My preference is to wait for the next pullback to enter them. All right, now I'm getting a lot of questions about Canadian banking stocks, so we'll look at those next. And again, they all look the same for the most part. Someone's asking me about Bank of Montreal, which is actually one of the better looking ones. So steep downward trend, break of the downward trend happened there. Build of a rising bottom just happened last week where we got the break from the rising bottom. Now the entry on BMO was actually on Monday at about $71 a share. We closed Friday at 75. Again, maybe it's going to pull back a little bit. Maybe you can get it closer to 71. I don't know that it'll come back that much. But if you have a longer term outlook, then I think it's okay even to buy it here. And as long as it can hold above 65, I'm okay with it. If it starts to close below 65, I'd be worried that it's going to retest the lows. So that's how I would look at it. Now, where did it come from? Well, it was at 100 and change a month ago, 6 weeks ago. Is it going to get back there? No, because their earnings are going to really suffer from this. But could it get back to 90? Yeah, at 90, it's still a big discount from where it was, which reflects the economic slowdown. But I prefer to maybe buy a little bit here. If it pulls back a bit more and then starts to break its pullback, then maybe add to that position. I want to emphasize, you don't have to buy everything on Monday. Like, this is a process of bottoming. It's going to take some time. What I just said about BMO, apply that to basically every Canadian bank. Now, someone asking about the sentiment and signal stock scores. There is a video on the website that explains how those are derived. For the current market, they have no application because we have such extreme volatility that they weren't designed for this kind of volatility. So right now you can ignore the stock scores, but normally we want the sentiment stock score to be above 60 and the signal stock score to be above 80. But again, I don't care about them right now because we just have this extreme volatility that's not normal. All right, next one is Novavax, NVAX, which is a stock that we actually day trade a lot because it's very active and volatile. And it is, to me, a stock that you would hold if you are a longer term trader and you own it already. I would not buy this here. I think it's too risky. It has made considerable gains. Just a few weeks ago it was at 7. It's doubled. It's now at 17. I would watch it for a break of this upward trend line. However, because this stock is so fast moving, I don't think you trade it off of the daily chart. I think it's better to trade it off of the intraday chart. So make a 1 month, 60-minute chart and hold this stock as long as it can hold that upward trend line. If it breaks this upward trend line from a falling top, so let's say Monday it goes up like this and then it makes a little falling top and then Tuesday it breaks down through it, at that point, I would sell. I would not buy the stock now, but I would hold it because it could still continue to do this and may as well enjoy it as long as that upward trend is intact. And these are some of the things that I teach in course material about when to sell these things. I'm giving you the quick and dirty version today. Someone asked me about Manulife. This is one of the stocks that I highlighted in my Market Minutes video on YouTube. So again, if you go to YouTube, go to 8 stocks to consider from the market crash. That's the video I uploaded yesterday, and Manulife was one of the stocks. So why do I like it? Well, downward trend line broken, build of a rising bottom, break from a rising bottom on Friday. I think this has a 70% chance of moving higher. Now think about that. 70% chance of moving higher means it has a 30% chance of moving lower, which is why we're going to control our risk by planning to sell it if it closes below 15.5, because 15.50 is basically our floor price here before the stock started to go up again. All right, so keep that in mind. Risk management is essential. I'm not right all the time. In fact, I'm often wrong. And risk management is how we stay in business. Peloton, PTON. Don't particularly like this. I just don't think it had the rapid and sharp decline that many stocks did. Yes, it did suffer, but it's made back most of those losses. You know, we're not far from where we started on Peloton. If you compare that with, Boeing, or let's actually do an airline, American Airlines, for example. Like, look at how far down American Airlines is from where it was, whereas Peloton is not that bad. Why? Well, Peloton sells bikes that you use in your home. You do exercise from home. What could be better for quarantine, right? Question about cruise lines in general. Cruise lines have been awesome traders in the last little while. We'll pull up RCL, which is a stock that I bought right here and sold it a few days later. It then pulled back again. It was another buy here. I did not buy the second time, although many of the people in my active live service did, because it was one of the stocks that we highlighted. And it's since come up fairly good. I think it's going to get stuck at $45. I think it pulls back again soon, but it's slowly building this pattern where it'll be like Manulife, MFC, was on Thursday. I think the cruise lines may start to show that pattern in the next week or two. And if they can start to break out from an ascending triangle, then I think they can start to recover. I think it's going to take more time. I like buying the cruise lines when they are weak and they break their weakness. Let me explain how you do that. Because this is a fast-moving stock and it moves, like, think about just in the last 4 days, it went from 22 to 40. It's a huge move, right? It doesn't look that big on this chart, but it does look bigger if we look at the 10-day chart. So what's our crash reversal pattern? There's our downward trend line. This is a 10-day, 30-minute chart. Crash reversal pattern, build of a little rising bottom, broke the rising bottom and breaks the downward trend line. So it's a buy there at $27 with a stop at 24, and then it went up, and then it broke the upward trend line on Thursday right here. So our exit point is at about 39. So our buy point was 27. This is 1 day, 2 day, 3 day, 4 days later. We're selling at 39. That's a $12 profit on a $27 trade. 45%, 40%. I'm just doing the math in my head really quick, but you get the idea. So that's the next thing to watch for. Is the next pullback. Watch for this same thing to happen again. If it pulls back for a few days and then breaks the pullback from a rising bottom, that'll be the next time to consider it. TripAdvisor. Travel stocks generally all look the same. So whether we look at airlines or websites that cater to travelers, that sort of thing, they're all pretty similar charts, basically really bad in the sense that they've broken down. But look at Trip. Rising bottom, downward trend line broken. I actually like it. I don't love it because it failed to close near its highs of the day on Friday. I keep saying Friday, but it was actually Thursday. Markets were closed on Friday. So it's pretty good. I would rate this a 6.5 out of 10. I wish it was a little stronger move. It's going to also have a little bit of difficulty getting through that $20 level, which was the last price peak. So it's good, not great. If you own it, I'd stick with it, but I think there's better ones to consider. There's so many questions here, and I apologize. I'm never going to get to all of these, but I'll do a few more. GPS is Gap Stores. So Gap Stores, if we look at the intraday chart, here it did it on Monday. So rising bottom, break from a rising bottom right there. Tremendous gain since then. That's $6.40 to $9. Too late now. The bus has left the station, but because the volatility in this market is there, very good chance it pulls back again. and does it again. I'll show you an example of that. DIN is a restaurant stock. And if I make this, I'm not actually certain it is, I believe it is. Let's go 1 month. And yeah, so this is, again, a stock that I traded back here. Why? Because it had the downward trend line, built a rising bottom, broke the rising bottom. Up for a few days, sell it there, then it did it again. Pulled back, broke, awesome, that's the next move. That's kind of like where Gap Stores is, right? It's just done this move. Well, it may very well do this again. It's coming up into resistance, probably good chance it pulls back, and we'll get another chance. You can trade in and out of the same stock numerous times in the weeks ahead because they're going to keep doing this crazy volatility. We haven't done it sort of a tech stock. This is Shopify. It's not really a tech stock, I guess, kind of a retailer. It hasn't suffered as much. Again, it doesn't get hurt as much because it's an online retailer. So, or they cater to online retailers. You've got your rising bottoms there. You're still in a downward trend. We haven't broken that yet. So I think we need to see that get broken. But I think there's better opportunities out there for buys. If you own this, I would stick with it. I think it'll be okay. Lots of volatility, obviously, but I think it can still be okay. So I'm going to wrap it up pretty quick here because we're getting a little long. I'm just going to see if there's any general questions. Someone asking me if I use options. I personally do not. Many of my students do because obviously you can get some leverage out of options. It's just not my area of expertise, so I don't really use them myself. But again, many of my students are using options. Someone asked me about gold. Let's just take a look at gold. And this is something I talked about in this weekend's Market Minutes video, which you can check out. And this is actually an important lesson for traders, and that is you have to be willing to change your view very quickly. I was very bearish on gold down in here because it just didn't give me any signal that it wanted to start to go up again. But that changed on this day here when we broke from a rising bottom, breaking that downward trend line. So my view on gold changed from one day to the next. And that's very important to understand is even the things that I say today, I might have a very different feeling at the end of Monday. And that's why you want to, follow my videos and that kind of thing, because you can stay updated that way. So gold made a very nice move since then, but it's now at long-term resistance. And so I think it probably gets stuck and pulls back. I would not want to be a buyer of gold here. It hasn't broken down yet, so I wouldn't sell either. But I suspect that there's a good chance that this little upward trend line could be broken in the near term. So with gold, I do like it longer term because long term, look at this long-term chart, it's in an upward trend. It's just gone up so fast in the last 3 weeks that I think it might stall here and see some profit taking. We're going to do Air Canada because I get a lot of questions about Air Canada. So symbol is T.AC. And here is your downward trend line. Here is your rising bottom, and it broke from the rising bottom on Tuesday or Wednesday. Hasn't gone up a lot yet. Our buy signal was probably at 18. Now it's at 20, so it's not run away. I would think that that's actually a pretty good stock. In general, I like a lot of the airlines, not all of them, but Alaska, United Airlines, Air Canada. Let's take a look at WestJet just for fun here. It's WestJet symbol. Oh no, WestJet's gone private, hasn't it? I don't know if it still trades. Yeah, WestJet was bought out. It's still showing, it's still printing here, but I think it's been bought out, so we can't look at that one anymore. So, but the Air Canada chart, I like. If you can be patient with it, I think so. It could pull back to even $15, so realize that there's going to be some volatility in it still. As long as it can hold above 14, I like it. If it starts moving down and closing below 14, I'd be a little bit concerned. All right, I'm going to wrap it up there. Again, if you're watching this as a video and you weren't able to log into the webinar live, my apologies, but that's why we do videos. So I will upload this video as soon as I can. If you're watching it live, great. If you're watching it as a video and you want more information, make sure that you attend one of the other webinars that we're going to do next week. So just go to upcoming events, and there are the titles and everything there. I hope to see lots of you Tuesday and Wednesday and Saturday next week. Have a great rest of the weekend. I hope you enjoy the long weekend, and we'll look forward to seeing you next week. Bye for now.